Hello, my name is Brant Hunt, and my channel is Discerning What is True. I am live tonight at on Facebook and YouTube and Odyssey. And Discerning What is True is actually on YouTube and also Odyssey. My talk is the fraud of bank loans and theft of labor by the banking system. So this is something I just recently got into, and there's a lot of books I'd like to continue to share, and hopefully we're going to continue to go through a lot of it. And basically, what I'm interested in is truth and how many lives have we been deceived by in our lives. As you get older, you begin to see things if you want to see them. So this particular book is written by a gentleman named Mark Allen Wasmuth. It's Wasmuth, The Fraud of Bank Loans. And we're going to start out, first of all, with he calls it the definitions here. And we're going to just deal with this part of it. First of all, it's divided in each particular chapter here, type of deal, or parts, he calls it, an appendix. So thank you for being here. I hope that you will learn something from us through this because I feel it's important for you to learn something and educate yourself. He starts out with the definitions here. A borrower is to attain upon a loan from the owner or other person having the right of deposition to engage the use of money by contract. This is based upon Ballantines Law Dictionary, and this is based upon State XREL. Kimball, versus School District 13, NEB 82, 88 in Ballantines Law Dictionary. Lender, he from whom a thing is borrowed. The contract of a loan confers rights, imposes a duties on the lender. The lender has the right to revoke the loan at his mere pleasure. This is based upon 9 Cowen, Cowen, R.687, 8 Johns, Rep. REP. 432, 1 TR 480, 2 CAMPB. Rep. REP 464, and is deemed the owner or proprietor of the thing during the period of the loan, based upon Bouvier's Law Dictionary. Tenant, one who occupies the premises of another in subordination to that other person's title and with it assent, express, or implied. 32 AM J1, that is J first, I and T, subsection 2. Broadly, any person having a tendency. 2. Still under tendency, tenant. A tenant, although having exclusive possession, charge, and control, is not an owner of the land within a statute making it unlawful for any person to hunt on the land of another without first having obtained permission of the owner. Synonymous, that is 2 ALR 799, S95, capital A, capital L, capital R 1099. And that is based upon Ballantines Law Dictionary. Owner, one who has complete dominion over a particular property. That's 42 AM J1, first proposition, subsection 37. The person whom the legal or equity title rests. Anonymous, I would say this is not anonymous, ANNO, colon, capital ALR 779, section 95, ALR again 1086. In common understanding, the person who, in case of destruction of property, must sustain the loss. 42 AM J1, first POP, subsection 37. 2 in the part of owner is as to the meaning of owner as used in statute relating to the assessment and collections of taxes. See anonymous, ANNO, colon, 2, capital A, capital L, capital R, 792 in Ballantines Law Dictionary. Money, UCC 1-201 in subsets of 24 means a medium of exchange currently authorized or adopted by a domestic or foreign government. The term includes a monetary unit of account established by an intergovernmental organization, or by agreement between two or more countries. Number 2 section here. I bet you thought, that is David H. Freeman, Federal Reserve Bank of New York, 4th edition, 1984, states, money is anything that has value that banks and people accept as money. Money does not have to be issued by the government. See Part 7 of this affidavit. Deposit. Title 12, USC section 1813/1 and possibly 1, definition of deposit under Federal Deposit Insurance Act. Number 1, the unpaid balance of money or its equivalent received or held by a bank or savings association in the usual course of business and for which it has given or is obliged or obligated to give credit, either conditionally or unconditionally, to a commercial, checking, savings, time, or thrift account, or which is in evidence by its certificate of deposit, thrift certificate, investment certificate, certificate of indebtedness, or other similar name, or check or draft drawn against a deposit account and certified by the bank or savings association, or a letter of credit, or a traveler's check on which the bank or savings association is primarily liable, provided that, without limiting the generality of the term money or its equivalent, any such account or instrument must be regarded as evidencing the receipt of the equivalent of money when credited or issued in exchange for checks or drafts or for promissory notes upon which the person obtaining any such credit or instrument is primarily or secondary liable, or for a charge against a deposit account, or in settlement of checks, drafts, or other instruments forwarded to such bank or savings association for collection. Next meaning. Credit banking /3, bookkeeping entry representing a deposit of funds into account. It's based upon Thomas P. Fitch, Barron's, Barron, Business Guide Dictionary of Banking Terms. Let's continue. Number 25. This is U.S. Constitution on debt. The U.S. Constitution, Article 1, Section 10 of the U.S. Constitution states, number 1, no state shall enter into any treaty, alliance, or confederation, grant letters of marque and reprisal, coin money, emit bills of credit, make anything but gold and silver coin a tender in payments of debt, pass any bill of attainder or ex facto law, or law impairing the obligation of contracts, or grant any title of nobility. Number 2, it is impossible to pay a debt using Federal Reserve notes. Note, Federal Reserve notes are debt instruments as evident by the word note, N-O-T-E, as in Federal Reserve note, that is on the dollar bill. Note is a debt instrument based upon Black's Law 4th edition. Number 2, Federal Reserve notes come in existence only by creating debt. Number 8, just under the subtitle, number 2, the sale of T-bills, meaning treasury bills, treasury notes, and treasury bonds. B, fractionalized banking on deposits. C, creating loans. So he's making it very clear here as he shares that the note is a debt instrument. That's based upon Black's Law 4th edition, folks. Okay? So what we have in this country since the 1930s, well, the Federal Reserve System was involved, and actually in 1912, they went through the Depression, and this is what took place under the Franklin Delano Roosevelt's administration. This is what began to take place and to eliminate gold and silver. Okay? So there's no way you can pay your debts. Okay? Continue. Modern Money Mechanics by the Federal Reserve Bank of Chicago, This is 1961, Part 3. This full document is available up on request. This is section 26 here he's going through. So he's basically continuing to give you a working knowledge here as he continues to explain what he's doing. Now he's going to go to the Federal Reserve banking system and their banking system, how they look at things. So this is by, again, this is the Federal Reserve Bank of Chicago, Part 3. The full document is available up on request. Number 26, the UCC 3-102, Section 6, regulations of the Board of Governors of the Federal Reserve System and operating circulars of the Federal Reserve Bank supersedes any inconsistent provisions of this article to the extent of the inconsistencies. Page 3 states, number 1, the actual process of money creation takes place primarily in banks. 2, they are book entries which result from the creditors of deposits of currencies and check and the proceeds of loans and investments to customers' account. 3, banks can build up deposits by increasing loans and investment. And let's say this again to you folks to get it really clear. Page 3 says the actual process of money creation takes place primarily in banks. So it's created in banks. There are book entries which result from the crediting of deposits of currency and checks and the proceeds of loans and investment to customers' account. 3, banks can build up deposits by increasing loans, hear that, and investments. Page 4 states, Section 4, bankers discovered that they could make loans merely by giving borrowers their promise to pay banknotes. In this way, banks began to create money. Page 6, this is Section 29. Continue with the Bank of Chicago. Of course, they do not really make loans out of money they receive as deposits. If they did this, they would be acting just like financial intermediaries and no additional money would be created. Number 6, what they do when they make loans is to accept promissory notes in exchange for credits they make to the borrower's deposit accounts. Continue on, page 30 here. I'm not page 30, page 7 states, and number 7 states, expansion takes place only if the banks which hold these assets reserves increase their loans or investments. Loans are made by crediting the borrower's deposit account, i.e. by creating additional deposit money. Continue, page 8 states, the lending bank, however, do not expect to retain the deposit they create through their loan operations. Number 9, loan-created deposits may be transferred to other banks, but they remain somewhere in the banking system. 10, any deposit he receives is new money to him, regardless of its ultimate source. 11, deposits expansion can proceed from investments as well as loans. Continue to page 11, shows a chart and states this. Thus, through stage after stage of expansion, money can grow to a total of 6 to 2/3 times the new reserve supply to the banking system. 13, as the new deposits created by loans at each state are added to these created at all early stages and those supplied by the initial reserve creating action. Page 26 states, these new loans add to bank deposits. Again, this is still from the Federal Reserve Bank of Chicago, 1961, Part 3. And this is a particular, looks like a sample of the book he's actually sharing, which is called Modern Money Mechanics, a workbook on deposit, currency, and bank reserves by the Federal Reserve Bank of Chicago. Modern money mechanics. Let me get a little bit more in here. Money is such a routine part of everyday living that its creation and acceptance are ordinarily taken for granted. although a user may, upon reflection, sense that money must come into being automatically as a result of economic activity or perhaps as the outgrowth of some government operation. Just how this happens or too often remains a mystery. The workbook is designed to help provide an understanding of the mechanics of money creation. While the process is not a simple one, it is hoped that the careful reader will gain a clever picture of the fundamental nature of money and how the money system in the United States works. So what is money? If money is viewed simply as a tool used to facilitate transactions, only those media that are readily accepted in exchange for goods, services, and other assets need to be considered. Many things from stones to cigarettes have served this monetary functions through the ages. Today in the United States, there are only two kinds of money in use of significant amounts: currency, that is paper money, and coins in the pockets and purses of the public, and demand deposits, that is the checking accounts in commercial banks. Notice they say commercial banks, okay? So there's also what they call investment banks also. And that's been merged. This is part of the Glass-Steagall Act back in the 1930s, as well as I recollect, basically compromising it. But anyway, they were actually separated. That is, the investment banks were involved in another area, and commercial banks is where most people use their money in a local bank. You usually don't have investment banks. That, during the 1990s, under the Clinton administration, was eliminated, and it became investment banks went together with commercial banks, which was a major no-no, folks. It's a major no-no, because now they can speculate, okay? The amount of currency is in use at any time depends solely on the public preferences. Since currency and demand deposits are freely convertible into each other at the option of the holder, both are money to an equal degree. However, for specific transactions, one form may be more convenient than the other. When a depositor cashes a check, he reduces the amount of deposits and increases the amount of currency in circulation. Conversely, when more currency is in circulation than is needed, some is returned to the banks in exchange for deposit. Currency held in banks' vaults is not a part of the money supply available for spending by the non-bank public. While currency is used for a great variety of small transactions, most of the dollar volume of money payments in our economy is made by check. 80% or $112 billion of the $140 billion total money supply at the beginning of 1961 was in the form of demand deposits. What makes money valuable? Neither paper currency nor deposits have value as a commodity. Intrinsically, a dollar bill is just a piece of paper. Deposits are merely book entries. Coins do have some intrinsic value as metal, but consider less than their face amount. What he's saying there, right quickly, if you notice this was done in 1961, there was still silver in those coins. You had copper in your pennies. You had nickel, which is a metal, in your nickels, and then dimes, quarters, half dollars, and even what they call dollar coins at that time had silver in them. And most of them at that time had 40% silver in their coins. What then makes these instruments, checks, paper money, and coins acceptable at face value is payment of all debts and for other monetary uses. Mainly, it is the confidence people have that they will be able to exchange such money for real goods and services whenever they choose to do so. This is partially a matter of law. Currency has been designated legal tender by the government. Paper currency is a liability of the government, and demand deposits are liability of the commercial banks, which stand ready to convert such deposit into currency or transfer their ownership at the request of depositors. Confidence in these forms of money seems also to be tied in some ways to the fact that there are assets on the books of the government and the banks equal to the amount of money outstanding, even though most of these assets themselves are no more than pieces of paper. such as customers' promissory notes, and it is well understood that money is not redeemable in them. But the real source of money's value is neither its commodity content nor what people think stands behind it. Commodities or services are more or less values because there are more or less of them relative to the amounts people want. Money, like anything else, derives its value from its scarcity in relation to its usefulness. Money usefulness is in its unique ability to command other goods and services and to permit a holder to be constantly ready to do so. How much is needed depends on the total volume of transactions in the economy at any given moment or any time, and the amount of money individuals and businesses want to keep on hand to take care of unexpected or future transactions. In order to keep the value of money stable, it is essential that the quantity be controlled. Money values can be measured only in terms of what it will buy. Therefore, changes in its value vary inversely with the general level of prices. If the volume of money rises faster, assuming a constant rate of use, then the production of real goods and services grows under the limitation of time and physical facilities. Prices will then rise because there is more money per unit of goods. Such a development would reduce the value of money, even though the monetary unit was backed by and redeemable in the soundest assets imaginable. But if, on the other hand, growth in the supply of money does not keep pace with the economy, that is current production, either prices will fall or more likely some resources and production facilities will be less than fully employed. Just how large the stock of money needs to be in order to handle the work of the economy without exerting undue influence on the price levels depends on how intensely the supply is being used. All demand deposits in currency are a part of somebody's spendable funds at any given time, moving from one owner to another as transactions take place. Some holders spend money quickly after they get it, making these dollars available for other uses. Others, however, hold dollars for longer periods. Obviously, when dollars move into hands where they do little or no work, more of them are needed to accomplish any given volume transaction. So you see that what he's talking about here, which was at one time banks used to give you interest on putting their money in there, and so they would basically earn interest on it. What he's saying simply, there are people who actually have holders get it, making these dollars available for other uses. Others, however, hold dollars for longer periods, you see. Some spend it all, and it goes right back to whoever that is being deposited back into. It's a circulation deal, they're saying, okay? So who is responsible for the creation of money? Changes in the quality of money may originate with actions of the Federal Reserve System, that is the central bank. The central bank, the commercial banks, the public, but the major control rests with the central bank. But let's get to the meat of it. The actual process of money creation takes place in the commercial banks. As noted earlier, the demand liabilities of commercial banks are money. They are book entries. They're telling you what they're doing, folks. They are book entries which result from the crediting or depositing of currency and checks and the proceeds of loans and investment to customers' accounts. So it's just like you see on one side, you have two sides here. One is the credit side and one is the debit side. Okay. This is what we call standard accounting. It's just accounting deal. Okay. There are book entries. Okay, I did that. Okay, loans and investments to customer account. Banks can build up deposits by increasing loans and investments so long as they keep enough currency on hand to redeem whatever amount the holders of deposits want to convert into currency. This unique attribute of the banking business was discovered several centuries ago. At one time, bankers were merely middlemen. They made a profit by accepting gold and coins brought to them for safekeeping and lending them to borrowers. But they soon found that the receipts they issued to deposits were being used as a means of payment. These receipts were acceptable as money since whoever held them could go to the banker and exchange them for metallized money, as coins. In the past used to be coins. There was no to the modern phenomenon, what we call today paper money. That's a modern phenomenon. Okay, used to be all coins. Then bankers discovered that they could make loans merely by giving borrowers their promise to pay, banknotes. In this way, banks began to create money. More notes could be issued than the gold and coin on hand because only a portion of the notes outstanding would be presented for payment at any one time. Enough metallic money had to be kept on hand, of course, to redeem whatever volumes of notes was presented for payment. Remember, this is the key. What caused problems in the past is that simply is that many banks began to speculate, what we would call, say there's $2 million worth of coins in the bank. And so that meant simply is that there were $2 million worth of people out there with either with notes, not paper money, but notes, stated they would such and such. So when they came in, such and such. Well, what happened simply is they got greedy and they began to loan out money they didn't have. You see, so instead of $2 million, it would be $2.5 million. And if someone suddenly has a run on the bank, that bank cannot hold on, because what happens simply is they've loaned out $500,000 more than they have. Continue. Deposits are the modern counterpart of what we call banknotes. It was a small step from printing notes to making book entries to the credit of borrowers, which could be spent by the use of checks. And checks is also a modern type of phenomenon too. What limits the amount of money banks can create? If deposit money can be created so easily, what is to prevent banks from making too much? More is needed to handle the volume of transactions resulting from optimal use of the nation's productive resources of stable prices. Like its predecessor, the modern bank must keep a considerable amount of currency or balance with the central bank on hand. It must be prepared to convert deposit money into currency for those depositors who request currency. That's what you have to do. You must take remittance on checks written by depositors and presented for payment by other banks. Settle adverse clearing. Finally, a member bank must maintain legal reserves equal to some prescribed percentage of deposits. You see. So you see there, you see this. He didn't say, it's kind of interesting when he said this. That's kind of made me stop. A member bank must maintain legal reserves equal to some prescribed percentage of bank deposits. He didn't say 100%, does he? I would think he would say 100%. It's true. Let's continue on. Just my speculation, okay? How do operating needs and legal requirements affect the amount of deposits that the commercial banking system can create? The public demand for currency varies greatly, but generally follows a seasonal pattern which is quite predictable. The effects of these swings are usually offset by central bank action, are thus prevented from causing large temporary fluctuations to the quantity of money. Moreover, for all banks taken together, there is no net drain of funds through clearing. A check drawn on one bank will normally be deposited to the credits of another account in the same as another bank. The main factor, therefore, which limits the ability of the banking system to increase demand deposits, by expanding loans and investments, is the reserves that banks must hold against deposits. Growth of deposits can continue on to the point where existing reserves are just sufficient to satisfy legal requirements. If reserves of 20% are required, for example, total deposits can expand only until they are 5 times as large as reserves. $10 million of assessed reserves in excess of 20% requirements would support up to 50 million additional deposit. The lower the percentage requirement, the greater the the expansion power of each reserve dollar. It is this, what we call fractional reserve system, that sets the potential and the limits to money creation. What are bank reserves? Currency held in member banks' vaults may be counted as legal reserves. The major part of member banks' reserves, however, is in the form of deposits, reserve balances at the Federal Reserve Bank. A bank can always attain, bank can always attain. What does it do that for? I guess that's the end of the sentence. Wrote this book, The Reason of Simplicity. Okay, all right, so we're going to continue on. Here's page 3. Let us assume that expansion of the money supply is desired. One way the central bank can initiate such a expansion is through purchases of securities in the open market, thus adding to the reserves of member banks. Such purchases, that is, sales, are called open market operations. How do open market purchases add to bank reserves and deposits? The Federal Reserve System, through its New York office, buys $1 million of Treasury bills from a government securities dealer in New York. The Federal Reserve Bank pays for the securities with a check issued on itself and signed by one of its officers. The dealer deposits this check in his account with a commercial bank, that is Bank A, which sends it for collections and immediately credit to his reserve account at the Federal Reserve Bank of New York. The Federal Reserve System has added $1 million of securities to its assets, which has paid for in effect by creating member bank reserves. On the commercial bank books, these reserves are matched by $1 million of additional demand deposit money, which did not exist before. How the multiple expansion process works. If the process ended here, there would be no multiple expansion. That is, deposits and bank reserves have changed by the same amount. However, member banks are required to maintain reserves equal to only a fraction of their deposits. Reserves in excess of this amount may be used to increase earning assets, loans, and investment. Under current regulations, banks in large cities are required to have a higher percentage of reserves against demand deposits than they are banks in smaller communities. But the average of all member banks is about 15%. You hear that? Assuming for simplicity a uniform 15% reserve ratio and further assuming that all commercial banks attempt to remain fully invested, we can now trace the process of expansion in demand deposit, which can take place on the basis of additional reserves provided as a result of the Federal Reserve System purchase of securities. The expansion process may or may not begin with Bank A, depending on what the dealer does with the money he received from the sale of securities. If he immediately writes checks for $1 million and all of them are deposited in other banks, Bank A loses both deposits and reserves and shows no net change as a result of the system's open market purchases. However, other banks have received them. Most likely, part of the deposits will remain with Bank A and part will be shifted to a number of other banks as the dealer checks clear. It does not really matter where this money is at any given time. The important fact is that these deposits do not disappear. They are in some deposit accounts at all times. All banks together have $1 million of deposits and reserves that they did not have before. However, they are not required to keep $1 million of reserve against the $1 million of deposits. You see what's going on here? All they need to retain under a 15% reserve requirement is $150,000. The remaining $850,000 is assessed reserves. This amount can be loaned or invested. Do you see what's going on here, folks? Continue. If business is active, these banks will probably have opportunities to loan $850,000. Of course, they do not really make loans out of the money they receive at deposits. Get it? If they did this, they would be acting just like financial intermediaries and no additional money would be created. What they do when they make loans is to accept promissory notes in exchange for credits they make to the borrower's deposit accounts. Loans means assets, and deposits means liabilities. You get it? Both rise by $850,000 on both sides. See, the asset side and the liability side, whichever way you want to see it. Reserves are unchanged by the loan transaction, but that deposit credits constitutes new addition to the total deposits of the banking system. This is the beginning of the deposit expansion process. Of course it is. They're creating money out of nothing, folks. That's what they're telling you. In the first step, this is all new to me. So I've heard this before, but I mean, this is from their info. In the first step of the process, total loans and deposits of the commercial banks rise by amount equal to the assessed reserves existing before any loans were made. Okay. So it has an example here. The amount in the following illustrations are in thousands of dollars, and they have a little, again, they have what they have the assets on one side, the liabilities. And what they're showing is what we call here is that they have the Federal Reserve System over here, a form of accounting, and on this side is assets, and on this side is liabilities. Okay, and then there's a line in between it. And then with the commercial bank A, same thing is you have assets on this side and liabilities on this side. And then there's a dividing line again. It's just a standard accounting process. So when the Federal Reserve Bank purchases government securities, the reserve deposit of a member bank is credited. Now see, where is that money coming from too, folks? It's coming from the government. This happens because the seller of the securities deposits a check he receives in payment of the bank, that is Bank A, and the bank forwards this check to the Reserve Bank for credit to his reserve account. This customer deposit is likely to be transferred in part to either other banks and quickly loses its identity amid the huge interbank flow of deposits. Some banks now have what they call SS reserves on the basis of which deposit expansion can take place. Remember now, let's just make something here, share something else. You are the creditor. All people are the creditors, but they've told you that you're a debtor. But you yourself, in reality, you are a creditor. This country would have never started, folks. That's why they wanted people to come here, because you're an asset. You're an asset either if you're on a farm, you work in a factory, or you're a custodian, or whatever you do, you're an asset to this country. You would be in anywhere, any other countries. But it was always bringing other people from Europe here at first to have people come here and settle in order to eventually, what we call, create a system that would allow you to be a creditor, because you were a creditor. See, you bought some land at a good price, and you were promised that land. In fact, that was your land. If that was it, that was it. There was no taxes until later on, over 100 years later. Stage one, expansion takes place only if the banks which hold these SS reserves increase their loans to or investments. Loans are made by crediting the borrower's deposit account by creating additional deposit bank. So here we go. Here's the stage one bank. It's showing again on this is the asset of what we call plus $850 or $850,000, whatever. I remember what it was, $850,000. And then on the other side, the borrower's deposit is a plus $850,000 again. One showing asset, one saying the same thing. Okay. Let's go into part three. At the end of stage one, deposits have risen to by $850,000 in addition to the original $1 million provided by the Federal Reserve action, and $127,500,000 is 15% of $850,000 of assessed reserves have been absorbed by this additional deposit growth. The lending bank, however, do not expect to retain deposits they create through their loan operations. Borrowers write checks which will probably be deposited in other banks. As these are cleared, the Federal Reserve banks debit the reserve accounts of the paying bank, stage one bank, and credit those of the receiving banks. See, that was illustrated in the illustration of section 5 here. Whether stage one banks actually do lose their deposit to other banks, or whether any of all of the borrowers' checks are redeposited in these same banks, makes no difference in the expansion process, because the lending banks expect to lose these deposits and an equal amount of reserves. They are not likely to lend more than their assessed reserves. Like the original $1 million deposit, the loan created deposits may be transferred to other banks, but they remain somewhere in the banking system. Whichever bank holds them also has equal amount of reserves, of which, with respect, 15% will be assessed. Assuming that the banks holding the $850,000 deposit created in stage one in turn makes loans equal their assets and reserves, then loans and deposits will rise by a third of $722,500 in the second stage of expansion. See what's going on here, folks? So he's just showed you, as he's talking about here, he's showing us simply there's a 15% of $850,000. Well, that's $85,000 is 10%. So that would see, I'm trying to figure out how this thing works here in my own head here. That would be $127,500, she said earlier. It's 85 plus 85 is, let's see, I got to write it down, make sure I know what I'm doing here. I might be wrong. Let's see. Well, this shows $170,000. That's not what I'm thinking. Oh, no, is that 85? Wait a minute. Whoa. No. That's 85,000 originally. Okay, and then the 42,500, half of that. That leaves at $500. Makes 12. Let's see, 1, 4. Okay, yes. Okay, that makes sense. All right. Okay, good. So he did half of that again. That's what they did. So 7. Okay. 127,000. Okay. All right. Just want to make sure I knew what's understanding myself. Okay. Okay. So back down to the stage here. So what, this is being divided up. Okay. So assuming that the banks holding the $850,000 of deposits created in stage 1 in turn make loans equal to their assessed reserves, then loans and deposits will rise by a third of $722,500, second stage of expansion. This process can continue until deposits have risen to the point where all the reserves provided by the purchase of government securities by the Federal Reserve Bank or the Federal Reserve System are just sufficient to satisfy reserve requirements against those deposits. An individual banker, of course, is not concerned as to the stage of expansion in which he may be participating. In his operation, he is constantly experiencing inflows and outflows of deposits. Any deposits he receives is new money and to him, regardless of its ultimate source. And investment equal to whatever reserves he has in excess of his legal requirements, he will be carrying on the expansion process. Do you understand what's going on here, folks? I don't know if you want to keep your money in the bank. How much can deposit expand in the banking system? The total amount of expansions that can take place is illustrated in page 11, which I'm not able to share at this point. Carried through theoretical limits, the initial $1 million of reserves is distributed throughout the banking system. This rise to expansion of 666,657 of commercial bank credit. So they've created money out of nothing. Loans and investments and support a total of 6.66667 a deposit under a 15% reserve requirement. This expansion further factors for a given amount of expansions it does. So it's just, you just use a fractional of 1/15, and then it comes up to 6.2%. Although an individual bank can expand its loans only by the amount of excess reserves, commercial banks as a group can expand credit by a multitude of any addition to their reserves. This is because the banks as a group are like one large bank in which checks drawn against borrowers' deposits results in credits to amounts of other deposits with no net change in the total deposits or reserves. Expansion through bank investments. Deposit expansions can proceed from investments as well as loans. Suppose that the demand for loans at stage 1 bank is slack. These banks would then probably purchase securities. If the sellers of the securities are customers, the banks would make payment by crediting the customer demand deposits. Deposit liabilities would rise just as they did when loans were made. More likely, these banks would purchase the securities through dealers, paying for them with checks on themselves or on the reserve accounts. These checks would be deposited in the seller's bank. In either case, the net effects on the banking system are identical with those resulting from the loan operation described above. So I'm showing here, as a result of the process so far, total assets and total liabilities of all commercial banks together have risen $1,850. So what we're looking at all commercial banks, still here, part 3, you see your asset over here, you have the liabilities here, okay? So the reserves with the Federal Reserve Bank, is $1 million. The loans were $850,000, and the total on the assets is 1.5, sorry, it's $1,850,000. And then on the other side, deposits would be the initial $1 million, and then the stage 1 plus $850,000. That makes a total of liabilities of $1,850,000. You see what's going on. The only 15% is kept back, okay? Assets reserves have been reduced by the amount required against the deposits created by the loans made in stage 1. Total reserves gained from initial deposits is $1 million. Required against initial deposits is $150,000. Required against stage 1 deposits is $128,000. That comes up to $278,000, and then that subtracted from $1 million is $722,000. Why do these banks stop increasing their loans and deposit when they still have excess reserves? Because borrowers write checks. When our deposit in the payee's bank on their account with the lending bank, as these checks are cleared, deposits created by stage 1 loans and an equal amount of reserves may be transferred to other banks. So he's showing here, I can't show it to you, but what he's showing simply is what we call the Federal Reserve Banks over here, stage 1 bank is over here. So the Federal Reserve Bank is showing what we call all liabilities, okay? So it's showing at the Federal Reserve Bank what we call a stage 1 bank of $850,000 in the negative, okay? And then the other bank is showing a positive of $850,000 again, okay? So we come up here with the negative part, it comes all the way up to stage 1 bank, and it says reserves with the Federal Reserve Banks is a negative $850,000. And on the other side, and on the liabilities, it's a negative $850,000. That's stage 1 bank. But in other banks, it's shown as this. Another come down here, accounting procedure again. The assets showing here and the liabilities. And what we're seeing here, the other $850,000 is shown as a positive on the asset side. And on the liability side is showing the same thing of a positive $850,000. You see? And that's called deposit expansion has just begun. And expansion continues as the banks, which have their excess reserves, increase their loans by their amount, crediting borrowers' deposits, creating still more money in the process. So stage 2 bank is over here, and it shows the assets of $722,000 on the asset side, and then it shows a positive $722,000 because they borrowed deposits of $722,000 also. Now, the banking system assets and liabilities have risen by a total of $2,572,000. So all commercial banks are now showing assets on this side and liabilities. The reserves with the Federal Reserve Bank is $1 million. Loans to stage 1 bank was $850,000. Loans to the stage 2 banks was $722,000 on the asset side, okay? So this is a positive $2.572 million, okay? And a deposit would do the same thing. It all adds up again with the initial $1 million, stage 1 bank, $850,000, stage 2 banks, liabilities of $722,000. It adds up to $2.572 million. So you see they've done this way. It's a very complicated system in some ways, but once you get the hang of it, you can see what's going on. So they're creating money out of nothing here, folks. This is what they're doing. There are still 614 unassessed reserves in the banking system. Total reserves gained from initial was $1 million. Required against initial deposit was $150,000. Required against stage 1 deposit was $128 million. I'm sorry, $128,000. Sorry. And reserve required on stage 2 was $108,000. That added all up to $386,000 from the $1 million deal. So when they subtract that, meaning it means becoming $614,000 sorry, coming down to being to stage 3 banks. So that will be available to stage 3 banks. Do you follow? Okay. Stage 8. As borrowers make payments, these reserves will be further dispensed, and the process can continue through many more stages and progressively smaller increments until the entire $1 million of reserves has been absorbed by deposit growth. As in apparently from the summary table of page 11, more than 4/5 of the expansion potential is reached after the first 10 stages. It should be understood that the stages of expansion do not occur simultaneously because some banks use their reserves incompletely or only after a considerable time lag. The process is in fact continuously. Expansion, moreover, may never reach its theoretically limits. And it's showing here what it's done with that. And I won't make it too much more complicated than it is. But what happens thus through stage after stage of expansion, money can grow to the total of 6 to 2/3 times the new reserve is supplied to the commercial banking system. So basically, it goes through 10 stages here. The initial $1 million is first set aside 15% each time, and eventually is 5 point. No, I'm sorry, not that. At the final stage, you can go all the way to stage 20, is showing here. Then the final stage will show $5.667 million, and it will show the same thing. It will be different on the other one. Be sorry, is that right? Yeah, it'll be on the other side also the same amount. As new deposit created by loans, I'm sorry, no, I'm wrong. No, I'm wrong about this. It comes up to the stage 20 comes up to $5.448 million. On the other side is $6.448 million. So it's $1 million more on the liabilities, what we call demand deposits, compared to loans and investments. Okay. And then at the final part, final stage, the stage says this at $5.667 million. And on this side, it's $1 million difference again, the $6.667 million. Okay. So as a new deposit created by loans, and each stage are added to these created at all earlier stages and those supplied by the initial reserve creating accounts. So you see what's happened here. Okay. You can't see, but I'm seeing it. Okay. So this is all fraud. You see, this is all fraud. See, this is how they do this. See, the point is what I'm trying to say. When they make a loan, folks, you are the credit. When you get a loan for a house, your credit is what gives you that house. But you signed that mortgage statement, and when you do that, you make yourself responsible in paying that back. They already offered that to you. They created it out of from nothing, but we've been lied to. Because see, you are a creditor, and you've been told always that you're a debtor. So let's say, let's say the house costs $100,000. Okay, they put all these pieces of paper, and you sign your name to it. And what you're doing is simply you're signing your name and saying you're responsible. But guess who has the credit for it? They're saying here, if you follow what I'm saying, you are the creditor. You see, you created that credit. It's out of thin air. You follow? But they fool you. Not only do you have to pay, let's say, $100,000, but you have to pay the interest back on that. So it's I don't know, say 10% on that. So if that's $100,000 and you and how many years it is, they're going to get, that's going to be 10% on that $100,000. And how long it takes, 15-year loan or 30-year loan, they're going to make more money probably the 30-year loan than they will the 15, but you will pay for your house in more time. If people really knew this, and see this stuff, the whole thing would come apart. People don't know this. Let's continue. When a member bank borrows from its Federal Reserve Bank, it borrows reserves. The acquisition of reserves. Now, reserves, folks, are just money. It's created out of nothing. Remember what he said here. I'm going to say this earlier here. We made the definitions earlier. Let's get back to the definitions here. So he's got here page 4. It says bankers discovered that they could make loans merely by giving borrowers their promise to pay, that is, a banknotes. In this way, banks began to create money. Of course, they don't make. Of course, they do not really make loans out of money they receive as deposit. If they did this, they would be acting just like financial intermediaries, and no additional money would be created. What they do when they make loans is to accept promissory notes in exchange for credit they make to the borrower's deposit account. Any deposit the bank receives is new money to him, regardless of its ultimate source. Deposit expansions can proceed from investments as well as loans. Thus, through stage after stage of expansion, money can grow to a total of 6.23 times the new reserve of supply to the banking system. They create money out of nothing. See? And that's why, how can these banks basically fail? Because basically, there's either they make poor decisions. A lot of them, I don't think, is they invest on other things. And that's what I'm trying to say. What simply is that you have to understand there are two types of banks. You see, you had the investment bankers and you had the commercial bankers. And what happened in the 1990s, which is took place, has made the situation more volatile. Now they can play with people's money unbelievably, and can fuck it up much easier. Okay. See if I can get back to my original theory where I was at. Okay, here we are. So when a member bank borrows from its Federal Reserve Bank, it borrows reserves. The acquisition of reserves in this matter difference is an important way from the cases already illustrated. Banks normally borrow only to make up reserve deficits, not to attain excess reserves. Borrow reserves, therefore, are reserves on which expansion has already taken place. How can this happen? In the efforts to accommodate customers as well as to keep fully invested, banks sometimes make loans in anticipation of deposit inflows that fail to materialize or do so less rapidly than expected. These new loans add to bank deposits, but not to bank reserves. Unlike excess reserves can be tapped, there will not be enough reserves to meet the reserve requirement against the new deposits. Likewise, individual banks may incur deficiencies through unexpected deposit outflows and corresponding losses of reserves through clearings. Other banks receive these deposits and can increase their loans accordingly, but the banks that lost them may not be able to reduce outstanding loans or investment in order to restore their reserves to required levels. In either case, a member bank may borrow reserves temporarily from its reserve bank. Suppose a customer at Bank A wants to borrow $100 on the basis of the management judgment that the bank reserves will rise sufficiently to provide the necessary funds. So this is all speculation too. They're hoping that this will continue on. The customer is accommodated. The loan is made by debiting loans and credit the customer deposit amount. Now Bank A deposits are increased by $100, but if reserves have not risen as expected, Bank A will have a $15 reserve deficiency, assuming requirements of 15%. If it borrows that amount from its Federal Reserve Bank, which makes a loan by giving the borrowing bank credit in the reserve amount and debiting discounts and advances. The member bank gains reserves and corresponding liabilities, bills payable, see illustration such and such. Since only enough reserves were borrowed to support deposits already in existence, so further expansion of these reserves is possible. Okay, Federal Reserve loans to its member banks are extended mainly to cover emergency type needs. But where does this money come from, folks? You see, it comes from the government. See, they print it, and they don't charge a fee to them. The banks do that. But come here. Borrow reserves must therefore be repaid within a relatively short period of time. Even in periods when the total volume of member banks borrowing is rising, some individual banks are repaying debt while others are borrowing. To repay borrowing, A bank must have gained reserves through either deposit growth or asset liquidation. A bank makes payment by authorizing a debit to his reserve account at the Federal Reserve Bank. Repayment of borrowing, therefore, reduces both reserves and bills payable. The adjustment made by some banks to get out of debt, such as sales or securities, tends to transfer reserve shortages to other banks and may force them to borrow, especially in periods of heavy credit demand. And the aggregate borrowing usually increases in periods of rising business activity when the public demands for credit are rising more rapidly than reserves are being provided by the system in another way. Discount policy is a tool of monetary control. Although reserve expansion through borrowing is initiated by member banks, the amount of reserves that banks can acquire in this way is limited by the Federal Reserve Discount Administration and by control of the rate charged banks on these loans. Discount rate. Loans are made only for approved purposes, and borrowing for extended periods is discouraged. A higher discount rate tends to restrain borrowing by increasing its cost. So I'm assuming they're talking about interest there. Discounting is an important adjunct to the other Federal Reserve tools of control. While the privilege of borrowing offers a safety valve to relieve temporary severe strains on the reserve positions of individual banks, there's a strong incentive to repay borrowing before adding further to loans and investment. So this is part 4. We were talking about part 3. The full document is available up on request. So what is done here, this was revised in 1992 here. Again, Modern Money Mechanics by the Federal Reserve Bank of Chicago, revised in 1992. So what we're talking about, all this other stuff was back in 1961. Now we're looking at part 4. 34 section, page 8 states, okay, the total amount of expansion that can take place illustrated on page 11, that is, can carry through to theoretical limits. The initial $10,000 reserve distributed within the banking system gives rise to expansion of $90,000 in bank credit, loans, and investment, and supports a total of $100,000 in new deposits under a 10% reserve requirement. So now it's changed from 15% in the past now to 10%. Okay. The deposit expansion factor for a given amount of new reserves is thus the reciprocal of the required reserve percentage of 1/0.10 equals 10%. Continue. Page 11 states, thus, through stage after stage of expansion, money can grow to a total of 10 times the new reserve supply to the banking system. Okay, so they've changed that. See, this was changed again in 1992. That's actually been over 30 years ago. This took place 30 years ago. So in part 4, this is it. This is the beginning of the deposit expansion process. In the first stage of the process, total loans to deposit the banks rise by an amount equal to the excess reserves existing for any loans were made 9% of the initial deposit increase. At the end of stage 1, deposits have risen a total of $19,000. Remember, it was $10,000. So now it rose to $9,000, making a total of $19,000. That $9,000 went in deposits created by stage 1 banks. See illustration 4. However, only $900, 10% of the $9,000 of excess reserves have been absorbed by the additional deposit growth at stage 1 banks. Okay, so they're taking that 10% out. Okay, that $9,000. The leading banks, however, do not expect to retain the deposit they created through their loan operations. Borrowers write checks that probably will be deposited in other banks, as they said. As these checks move through the collection process, the Federal Reserve Bank debits the reserve accounts on the paying bank, that is stage 1 banks, and credit those of the receiving banks. It's the same thing they're talking about. So if it's different, it's no longer 15%, it's now 10%. Okay, so this makes banks even more volatile, okay, because simply they're holding less money in reserves. So whether stage 1 banks actually do lose deposits to other banks, or whether any of all the various checks can redeposit to these new banks or the same banks, makes no difference in the expansion process. If the leading banks expect to lose these deposits and an equal amount of reserves, and the borrower checks are paid, they will not lend more than their excess reserves. Like the original $10,000 deposit, the loan-created deposits may be transferred to other banks, but they remain somewhere in the banking system. Whichever bank receives them also requires equal amount of reserves, of which all but 10% will be assessed. Now, I can see a problem already here, folks. Can you see it? What they're saying here is what I'm seeing. Yes, this could be a problem. All right, so if your bank's holding 10%, they can borrow from other banks. But the problem simply is that's based upon a region, certain areas, whatever. They're not, this is like robbing Peter to pay Paul, you see. But the problem if it occurs in all banks, then you're going to have a major problem. You see? You see? Now you understand? See, they're seeing only if it occurs regionally or, one or two cities here, da da da, da da da. So it's not occurring all throughout the country here. Okay? So assuming that the bank's holding the $9,000 of deposit created in stage one as terms makes loans equal to their assessed reserves, then loans deposit will rise by a leading other $8,100 in the second stage of expansion. This process can continue until deposits have risen to the point where all the reserves provided by the initial purchase of government securities by Federal Reserve systems are just sufficient to satisfy reserve requirements against the newly created deposit. Now remember here also one other thing. It's not them that's responsible for this, folks. It's the government. The government provides insurance for this. So if the government's providing that insurance, where are they going to get that money at? Okay. I understand what they're doing here also. This is why you also what we call, when we say worldwide, I spoke a little bit soon. So this banks here, say, for example, things are happening really bad. Well, what they do is they stop loaning money. That's how they hold on to more money so that they can actually deal with what I call the issue when there's a run on the bank or there's an issue of that nature. So that's what they do. And the other way to do that is simply increase interest rates. So if you really want that house bad enough, you want it really bad, you're going to pay 20% on the dollar, then they may give it to you if they see you will pay for it, although you may be a risk in some ways to them. But what they're doing is simply they're keeping as much money in the bank. So this is what they do. They begin to withdraw the whole. So they're no longer sending money out to the investments. They're holding on to it, holding on more of it. And this also creates problems. Part of that, what I said, the increases interest rates. That's part of the whole deal. The individual bank, of course, is not concerned with the stages of expansion in which it may participate. Inflows and outflows of deposit occurs contingently. Any deposit received is new money, regardless of any ultimate source. But it's bank policies to make loans. See, it's bank policy to make loans and investments equal to whatever reserves are in excess of legal requirement. The expansion process we carry on. This is very, we'll see. 15% was even low enough, folks. Now it's 10%. You see. How much can deposit expand in the banking system? Well, the total amount of expansions that can take place is illustrated on page 11, carried through the theoretical limits. The initial $10,000 of reserve distributed within the banking system giving rise to expansion of $90,000 in bank credit. So they create money always. That's what they're saying. Loans and investments. Yes, they extended out to others. That's what they always say. But in reality, it simply is, where did that money come from? It came out of nothing, folks. They just created it. And supports a total of $100,000 in new deposits under 10% reserve requirement. The deposit expansion factor for a given amount of new reserves is that the reciprocal of the required reserve percentage is 1/10, which is 10%. Loan expansion will be less by the amount of the initial injection. The multiple expansions is possible because the banks as a group are like one large bank, which checks drawn against borrowers' deposit results in credits to accounts of other deposits with no net change in total reserves. Expansion through bank investments. Deposit expansion can proceed from investment as well as loans. It's the same thing. Suppose that the demand for loans at some stage one bank is slack. These banks would then probably purchase securities. He's just saying the same thing. If the sellers of the securities were customers, the banks would make payment by crediting the customer's transaction account. Deposit liabilities would rise just as the loans have been made. More likely, these banks would purchase the securities through dealers, paying for them with checks or themselves or on their reserve accounts. These checks would be deposited in the seller's bank. In either case, the net effect on the banking system are identical with those resulting from loan operations. So he's giving an illustration showing this whole thing out just like it was earlier, but it's based upon 10% instead of 15%. So the initial required simply is that you would have, it was $10,000 total. Then it was required of holding reserves at $1,000, and that left $9,000 to be quote unquote assessed. That was money that was to be assessed. So what they did is stage one, it was required at that time, now that was required $1,900, but still assessed of $8,100, and loans investment of $9,000. And so what happens eventually when you get down to the bottom here at stage 20, that $10,000 that was there in reserves, eventually are loans and expansions, or what I'm calling investments, is $79,058. And the final stage simply would be $10,000 being the total, required $10,000, and the loans investment would be $90,000. You see, again, only 10% in reserves. You see, but being only $1,000. You see, but they're saying this is after the final stage, such and such, $90,000. So they continue to create money out of nothing here. And you can get away with this as long as things going okay. But you don't get away with it always, folks. And they do these things, like I said, they use interest rates as a way of slowing the economy down or speeding it up. As long as people are wanting to buy things, and that's what happens. Okay. All right, Two Faces of Debt by the Federal Reserve Bank of Chicago, revised edition of September 1992, Part 5. This is page 19 states, but the deposit balances rises when the deposit institution extends credit either by granting a loan to or by buying securities from the deposit. Again, this is based upon page 11 states. In exchange for the note of securities, the lending or investing institution credits the depositor's amount or gives a check that can be deposited at yet another depository at yet another institution. Number 3, in this case, no one loses the deposit. The money supply is increased. New money has been brought into the system. This is a constant. I would just like monopoly in some ways, folks. Such newly created funds are in addition to funds that our financial institution provide in their operations and to intermediaries between savers and users of savers. Number 5, a deposit created through lending is a debt that has to be paid on demand of the depository, just the same as the debt rising from a customer deposit of checks in a bank. Two faces of debt. Let's see how long I'm at here, folks. Yeah, it's over an hour. Let's see what you got. Okay. The banking issues let go. Let's see. Hold on. Let's see. It got some responses here. I didn't know anybody was here. It's based on department and trust. That's all. We are the trust. It's all just fuss, and the bankers get 80% of the cake. We are the government. Yes, we are the government. Yes, but the key is simply nobody knows that. You see, the Constitution states that. True. But the sad part simply is that trying to explain to what they're doing in the banks based upon somebody got their paperwork, and I don't know if someone got, this is what this is coming from. This is not someone who asked for this information. I believe someone actually worked at the bank and either sold this or gave it to someone or whatever, and this is what I'm reading from. And I found it actually a couple of days ago. And I wanted to share because I felt it was important, because this is something I've always thought they were doing. I sense that, and it's the way the bank issues. Let's go. Okay, IOUs. Yes, it's based on the department and trust. That's all. Yeah, it is. We are the trust. I understand that. There is a, and we are the government. Every IOU has a running time. It's about 15 to 30 years max. After that time, it has to be converted, and this is about time all over the world. Look at Nigeria. I don't know what's happening in Nigeria. You have to tell me that. I know that simply what has happened in Zimbabwe, which they were a country that completely is toast in some ways, because they kept spending money and their money wasn't worth anything, and because there wasn't producing anything in the country. They ran out all the farmers, um, and they allowed someone else to come in their country, especially China. Zimbabwe is rich in minerals enormously. So I don't know about the issue in Nigeria, Nico. You have to tell me that. I know that there are oils, pollution. They're actually probably, at this point in time, Nigeria is probably the richest country in Africa at this point. Unlike the situation maybe 20 years ago, we've been Libya, and before then, it had been basically during the days when I was in college, it was South Africa. South Africa was indeed the richest country in the world. Um, so, um, yeah, they basically create money. Yeah, it's all just fuss in the bankers. But the key is simply is when we go back in the past, we are looking at what I'll call the issue that we could pay our debts with real money, and we can't do that anymore. We're paying money. We're paying what I would call at this point. No, they can't print no more money. They're okay. Let me finish what I'm saying. You used to redeem, you'd be able to redeem it in gold and silver. They've gone away from that. Roosevelt destroyed that. That was the way, simply, is how to pay debts at that time. Yes, they want to. I understand that they're going to go digital. The government's going to make that work. They're going to force that upon us. I agree. So what used to be in the past was simply you had gold and silver. And my point here is to explain to you how valuable gold and silver was at one point at that time, and what's happened since then. When the government confiscated money from the people in the 1930s, they paid, I think, $20 or $25, correct me or not, as well as I recollect, for that 1 ounce coin. Now that coin, a year and a half ago, same coin, gold coin, 1 ounce, is worth $2,000. And it's probably worth even more than that. It's being controlled and manipulated by the market at this point. It's worth even more than that. We haven't yet seen real inflation yet. We've seen inflation, but the inflation is about to kick in probably in the next, I don't know, 3 or 4 months, maybe. You're not going to be able, it's going to be the point you're not going to be able to buy anything. They're also forcing this to happen with what I would call burning down all these factories on purpose that produce something. So this country is no longer going to be not even a tenth of what it used to be. It's going to be in far worse shape. We're going to be a third world country, and we're already in that situation. So what the government is going to do, when I say, Nico, is they're this whole thing with Bitcoin and others. They want those to work to a certain period where they can get people's money into it. And I don't know if it's government involved. I'm speculating at that. But the point simply is, if I understand it correctly, they want them to fail, and then they're going to come in, and the government's going to have control of, like, the Bitcoin deal. But it won't be. It'll be all digital. See, and the banks already do this digital. Like he's showing here, what I'm reading for is all what we call accounting issues. You see, but what they're doing now simply is they just produce money out of nothing. And it used to be they would have, and I assume they still do this in somewhat, they would have to print these cash dollars all the time. But they're notes. Notes are debts. They're debt money. You cannot pay a bill with a note. You have to pay a bill with real money. There's no other way you can do it. And so this whole idea is going to fall. It's not just here in the United States. It's going to all fall throughout the West. All countries are based upon fiat money are going to be destroyed. And it's been going on with what we call the BRICS countries. That is Brazil, that is Russia, India, China, South Africa, and just recently Saudi Arabia has joined that group. And what they're doing is they are buying gold in tons of money because they know the reckoning's coming. They know that. They see the handwriting on the wall. And the West is asinine because this is going to destroy the West. It's like going back in time, you see. And this will be a way, they're seeing this. I don't know what they're up to. Are they going to seize this moment with what I call, let's see, all right, you got Brazil, Russia, India, China, South Africa. You got 6 countries here that are involved with this. Compared to the IMF, which is the International Monetary Fund, which has been basically what I would call throwing money away, paper money, and buying assets. A lot of this has to do with actually what we call a book. I'm trying to think of it simply is that we go into countries and we destroy those countries because simply is we build dams, and these countries are so poor. And then what we do is we offer them, say, $10 million. We're going to build this thing for you. And then what happens simply is they can't pay that $10 million. And so the interest rates goes up. And that's what the IMF is all about. And then what happens, they keep charging. And eventually this country becomes so dependent upon that they can no longer afford that. And that's what happens to almost all countries in South America and in Africa. You see, they destroy themselves from within. And then they just simply, then they give it up. They give all their resources to these International Monetary Fund. And these 6 countries now are seeing, hey, wait. We don't want to be on that ball. We don't want to be on that procedure. We don't want to be involved with this. And so what he's saying, this particular thing, what I'm reading from tonight is basically what I call the fraud of bank loans. And this has to stop. And it's going to stop. It's going to stop. It's going to stop. It's going to be financial ruin for people here in this country and the West. That includes Japan, because Japan's not on board of this. It's going to include all of Europe, and it's going to include America, Mexico, Canada, all these countries, you see. All of them are going to fall. And what they want to do, instead of going back to the system that would go back to what we call all gold and silver, the point simply is they want to put us on a digital deal. And then my speculation is, will that affect, I don't know, will this affect the other 6 countries who have basically gotten out of this and seen this coming? Are they going to capitulate or not? Now, we know that China's already using digital money. We know that. We know some countries already. I know someone who lives in Holland, the Netherlands, or I'm sorry, not Denmark. They don't use cash. They don't use cash anymore. They don't take cash payments anymore in Denmark. As soon as people go, yeah, as soon as people go nuts. Yeah, people are, when this happens, you're going to have the same problem phenomenon that took place during the Great Depression, and people lose millions and millions of dollars or whatever on speculation or whatever. They had it all in paper money, and they're going to commit suicide because there's no way they can pay it back. And not with real money. And they don't see any light at the end of the tunnel. And many will do that. They will simply kill themselves. And the whole digital deal is basically, it's a social control. It's actually far better than the communist system, because when you have control of people with their money, when this is all built upon, then what happens simply is they can do checks and balances on you and say, well, we see you spending money on this, such and such, and we know it. You got to pay these taxes on this. So you're no longer with cash. With cash, you pay if you pay cash, the government doesn't know, it doesn't know you're getting something. And so what happens simply is they can't charge you tax on it. And so when everything's digital, They know everything you're buying and what you're buying. And if they don't like what you're buying, say you're buying too many uh, donuts or whatever, they'll say, well, if you better cut these donuts out. I'm just giving you illustrations, what I'm trying to say. So I haven't finished the whole book here. This is this is 62 pages of this, and I've only started at page 22. So I'm probably going to stop tonight because it's actually a little after 12 o'clock here on the Eastern Coast. But yes, what is taking place is the destruction of the West. And the other thing simply is critical for people to understand. There are 5 major things that go on in a capitalist society or society in order to be free in the way of, being industrial. And that would be simply in the area of what we call fishing, manufacturing, farming, mining, and timber. Those are the 5 areas of that. So there's 5 ways of making what I would call being productive. And those are the 5 I'm sharing with you. And what the United States has done is that we've shot ourselves in the foot. And we create not only the United States, and everybody's looking into the dollar. So the same things that happened in Venezuela recently, the last 3 years ago, is going to happen here. The same thing has happened to Argentina a couple times. Same thing has happened to Brazil. All these countries have gone through, and this drastic change that took place in Zimbabwe, that basically they printed up. I don't know if you guys know this. They printed $1 million bills, and basically it was a joke. It's just paper, but they thought they could fool people saying $1 million. You see, resources. Yeah, correct. Yes, and there are resources here in the United States, but we're not using them. We have actually committed to what I would call suicide. That's what this country's done in the last 100 years. And this all started with Woodrow Wilson, which I've done videos about him and what he did with Colonel Mandel House, who fooled him, or basically allowed him to fool him. It's a progressive perspective. And Mr. Woodrow Wilson was pretty much, he called himself a progressive, but he was very much a socialist, communist slash. Okay. And he allowed this whole thing to take place with the Federal Reserve System. You see, at that time before then, who was making the money? And it was based upon gold and silver. So that actually was strict. The government was strictly, say you had 100,000, let's just say $100,000 of money, real money, that is gold. Okay. Well, you can only print up enough money for $100,000. You see, that was the constraints that kept everything in tow. Although they still could frustrate what I call these banks to try and play with the interest rates, such and such. But in reality, the government had control of that, and it would not be what you call as bad. But now what's happened simply is the government's forfeited its right to print money and has given that money to 6 private individual bankers that are some here in the United States, but most are in Europe, and they destroyed this country. And my speculation, what I've read, understand, there would not have been a World War I, there would not have been a World War II, because simply is there would not have been money to be produced here in the United States to create a wars, and that's what you do. And you provide money, banks do this, seriously, they give money to both sides, and they bet on which side's going to win, you see. So if it's Germany, England, or whatever, Russia, whatever, it's all based upon that. And so it's a dilemma. It's, we thought, you think about it, and I grew up in the 60s, so I'm 62 years old, and there were jobs plentiful when I went out and got out of work, when I graduated high school in 78. So jobs were plentiful, but they're not plentiful now, and they're not good paying jobs. When you got paid, at that time in the 1970s, the the inflation rate was very low. It was there, I granted. But the key was simply is, if you made $5 an hour back then, you were set. You were set already. You're in good shape. You can't, today, you multiply that by 10 times, inflation's gone that bad. So let's say, okay, how did this change? Well, Nixon took us off the gold standard in 1971. Okay, and the gold was at that point was, I think it was $35 an ounce. Don't quote me that, but that's $10 more than what it was 40 years before. Now look at what gold is worth now, and it's worth far more than that. It's being pressured to be even lower. It's worth far more than that. So let's just say a year ago it was at a high of $2,000, and then you have to realize the massive inflation is going on. And then those that have any gold and can hold on to it, it's a security. It's not a money-making deal. It's a protection against inflation. That's what gold is. And then silver is used as a buying or trading deal with people because it's more interchangeable. And then if you have what we call 40% silver or 90% silver coins, then what you do, you can exchange those into buying or bartering people. You can barter with people, or you can barter with simply still. And that's the only way to do this. But the problem simply is so few people see this. They don't want to see this because this is so bad. They just deny it. That's what's the fucking problem, you see. Yeah, gold is the most fixed off, correct. Although they manipulate it with paper gold. I don't know if you know that. They play with that too. And they've been playing with it for the last, well, 8 months, so to speak. Yeah, manipulated. You know, they come out with a government report back in December, and this was where gold was already moving back up. And they said that there were employments jumped over 500,000 people. And that's all bullshit, folks. That was a lie. And the stock market suddenly went up, and the gold went down. It was a manipulation. And it was also to make people feel like everything's back. The wheels are back on the train here. We're going to moving back forward. In reality, that's not the truth. Governments always lie about things like this. They never tell the truth to the people. Because if they told the truth, people go completely bananas. But they're going to go bananas anyway. They know that. So anyway, I appreciate you guys being here. I see you. There was as many as 6 or 7 people here. There's a couple of people here. I appreciate your input, Nico. Jay, thank you. You seem to be the only one sharing here. There's, anybody's welcome to share. The more the merrier. But my concern is that think about the young people today who are unaware of what's going on. I have a neighbor, not too close to me, but a neighbor who is young and is younger than 30 years old and still lives at home and is in debt $30,000. That's unbelievable, folks. Doesn't have any collateral, as we would say. Not even a car, you see. And yet, I have no friends. Well, that's about the way it goes, my friend. Yeah, it does, because if you're speaking about things like this and serious issues, you may be best not to have friends, Nico, because basically those friends are not trustworthy. It's a lonely path. It's a lonely path if you're pursuing truth these days. And that's, that should be your goal in life, is to find out the truth about why you're here, what is your purpose, and in a lot of ways simply is where are you going. And most people are consumed by trying to be somebody they're not. And what happens is that they don't really know what is going on because they're just being manipulated. So anyway, thank you. It's been 1 hour and 30 minutes. Appreciate you guys being here. Where are you guys from? Are you guys from the U.S. or are you from other countries here? If you want to share, if you don't, that's fine. But anyway, I will conclude and try to do this another next day or two. We'll do another video on this because there's plenty of information about this. Again, this is from the Bank of Chicago, sharing this information not only based upon 1961. Oh, you're in Germany. Okay, good. Sprechen die Deutsch. Good to see you. Good to meet you, I should say. Haven't seen you. But the key is simply is that what was I referring to? Was the issue of how so many people are in debt in this country. And this country was, when I was young, was a producing country, and it's been self-inflicted wounds. And I assume it's the same way in Europe. Like I said, this lady I know in Denmark told me that, and I was blown. I was wild about that. That is due with them no longer exchanging dollars, or they wouldn't be dollars, but it would be the Denmark. I would say mark. That would be the marks. German Dutch mark would be in Germany, but I assume Denmark being a Dutch, not Dutch, but probably Danish. So they speak Danish, but they're also closely associated with German. So. But anyway, it's good to be here. So it is 6 hours ahead. It must be early in the morning there in Germany. I would assume it's probably 6:30, 7 a.m. Have a good night, or have a good day, I should say, and I'll say good night for you guys here on the East Coast. All right. Thanks for being here. Thank you for your comments. Appreciate those. Always like to interchange with others, and always learn something from someone also. Thank you. You have a good night and a good day. Take care.